All right, everybody ready? Want to get started? Okay, welcome back. Class 7, today's the last weekend we'll be together. Today we are going to start talking about M&A. And just the roadmap for the rest of the way, today we're going to talk about merger modeling. So we'll just spend a little bit of time in PowerPoint on the lecture, then we'll go and we'll build a merger model, a shortcut M&A model in class. And then after that we're going to talk about the M&A sale process. So what do bankers do once they've been engaged by a company to sell that company? What is the process that gets followed in doing that? We'll probably get done a little bit early today. We typically do. And then tomorrow we'll talk about the pitching process, the process bankers use to go sell their services and market themselves. We'll also talk about recruiting, interview questions, that type of thing. Also kind of a course review, some of the key concepts. So that's the roadmap the rest of the way out. So let's talk a little bit about a shortcut model. All right, again, this is what we're going to be building in class, and this is basically a model that bankers can quickly use to figure out the impact on a buyer's earnings per share of doing a particular M&A transaction. All right, and specifically what we're looking for is we're looking to figure out, is the deal accretive or is it dilutive? All right, let's first define those. What do I mean by accretion or dilution? Who can tell me? On a per share basis. On a per share basis. So if we talk about earnings per share, everybody's probably heard this, especially if you've ever read an analyst report. They talk a lot about earnings per share. Earnings that are available to the common shareholders of the company. The way that's calculated is net income divided by shares outstanding, fully diluted shares outstanding, right? Always on a fully diluted basis. And when we talk about this in the context of M&A and figuring out whether a deal is accretive or dilutive, what we're trying to say is, does the deal make earnings per share go down or does it make it go up? Okay, is it dilutive to the shareholders or is it accretive? Real simple, all right? What happens to EPS? Does it go down? Does it go up? Is it dilutive or is it accretive? Does that make sense? All right, so that's what we're trying to measure here. The reason we try and measure this is because obviously the market pays very close attention to earnings per share. Like I said, any analyst report will talk about it. Anytime a deal is announced, you'll typically read somewhere in that press release what the buyer believes is going to happen to their earnings per share. You'll hear things like, we believe it will be slightly dilutive based on LTM earnings per share, but we believe based on cost synergies and whatnot, it's going to be accretive to earnings per share in year 1, year 2, and beyond. All right? And because of that, it's a great deal. You should buy our stock, etc. All right, so that's basically why it's done. And it's used, whenever a buyer and a seller are public. All right? But even if the buyer is public and the seller is private, you'll see this deal being done as well. All right, again, this is focused on what happens to the buyer's earnings per share. If the buyer is public, this is going to be a very important analysis to conduct. All right, so here we have a quick example. If there's any dilution in the share price, assuming a constant PE multiple, right, in this case a multiple of 10, if before the deal there was a current share price of 10, earnings per share of 1, all right, if after the deal it's a dilutive deal, it drives earnings per share down to 90 cents, then if we apply that 10 times PE multiple, we'd see a corresponding 10% dip in the stock price. All right? Pretty important. When a CEO is getting compensated on what happens to the stock price, if the stock goes down 10%, that's going to be a major issue. So let's talk about a few of the things that cause dilution in the buyer's stock price. And again, when I say dilution, I'm talking about anything that causes this ratio to go down. So if we think just purely in mathematical terms, anything that causes this fraction to fall is going to be a dilutive deal. Right? So anything that causes the net income to fall, all right, maybe one of these things is the buyer buys a company that's losing money, most obviously. All right, the buyer buys a company that's losing money, net income declines, everything else stays the same, that'll be a dilutive deal. Make sense? All right. Another thing is if the deal is funded using a lot of stock. Right? So the denominator is going up and maybe net income is staying the same, or the denominator is just going up faster than the numerator, that'll be a dilutive deal as well. Okay, but even if there's a deal where no stock is issued, maybe the buyer is paying cash for the transaction, that cash portion of the purchase price needs to be financed. Okay, and there are two different ways we can finance that cash portion. Either the buyer could borrow, all right? What happens anytime we borrow? We get interest expense, we have more interest, and it could cause net income to go down. All right, so by borrowing the cash portion of that purchase price, that could drive net income down, that could be dilutive. All right, at the same time, the buyer might use even its own balance sheet cash. Well, if they use their own balance sheet cash, that's less cash on which they can earn interest income. They now have lower interest income, they might have lower net income as a result as well. All right, so it doesn't need to necessarily be a stock deal to be dilutive. Cash deals can be dilutive as well for those two factors, either borrowing the cash portion and incurring interest expense, or using cash from the balance sheet and losing interest income. Okay. Another item, and this is becoming less and less an issue as fewer and fewer deal fees can be amortized, but if the buyer incurs a lot of amortizable intangibles, that is, in this case, financing fees that can be capitalized, put on the balance sheet, and amortized over time, that amortization expense could reduce net income as well. Right? Again, less and less of an issue as accounting rules now allow us to capitalize fewer and fewer items. Right? And then the last thing we'll talk about is actually the first bullet point. If the target has a higher price earnings multiple than the buyer, and the buyer is issuing stock to do the deal, that can be a dilutive transaction as well. That one isn't, I think, as easy to understand as some of the others that we've outlined, but the transaction that we're going to model here in class, hypothetical transaction, will illustrate this. So let's say a buyer is trading their own stocks being valued at 10x, 10 times earnings. Seller, as part of the deal, the purchase price values the seller at 12 times earnings. The buyer issues shares. All right, that can be a dilutive transaction. They have to issue proportionately more stock to compensate for that higher price earnings multiple. Again, we'll see that in class. In the example, we'll see that basically shares outstanding are rising more quickly than the net income is rising as a result of the deal. So do these items make sense? I think they're pretty intuitive. And again, if you ever have any questions on this, think in purely mathematical terms. What causes the numerator to go down? What causes the denominator to go up? So when we build this shortcut model, the reason we call it a shortcut model is because as opposed to a full-blown merger model, we require less information. All right, so if we have the following items for both our buyer and our seller, if we have their fully diluted share counts, if we have their share prices, if we have their balance sheets, if we have their latest 12 months and their future earnings per share, and obviously if we know a little bit of information about the offer, specifically what's the premium being offered, what's the consideration, is it cash, is it stock, if it's cash, how much of that cash purchase price is being financed with debt versus balance sheet cash, etc. And then any debt that gets assumed in connection with the deal. We're going to spread a hypothetical transaction today where I believe it's Kraft buys Kellogg. All right, so we've assumed that hypothetically Kraft decides to make an offer to buy Kellogg. We've assumed a deal structure. And because we've already spread both companies, getting back to our valuation analysis we did in classes 2 and 3, we spread both companies. We have all this information, share prices, fully diluted share counts, balance sheets, etc. We can build a model around that, and that's basically what we're going to do in class. All right. Shortcut model is pretty straightforward to do. Again, a full-blown merger model, you're going to need a lot more assumptions. We'll review one of those later today, and I'll show you what's included in that. But again, after we've done this analysis, you'll have all the tools needed to do that. It's kind of a fun exercise. So at the end of the day, what this model tells us is obviously, is a deal accretive or dilutive? I mean, that's what we're talking about here. But it also can tell us a few more items as well. It can tell us what is the pro forma ownership structure of the combined companies. All right, that is how much of the combined entity does the buyer shareholders own? How much is owned by the selling shareholders? Right? In an all-cash deal, it's 100% owned by the buyer. Right? But you'll see in a stock deal that ownership can be a little different for each company, depending on the exchange ratio. If the deal looks to be dilutive, we're going to be able to calculate something called pre-tax synergies required to break even. What are synergies?
Synergy is a 2 plus 2, 5 concept.
Yeah, 2 plus 2 is something greater than 4. All right, so buyer buys a seller, maybe because of various aspects of that seller's business. The buyer can shut down some underperforming locations, they can reduce headcount, they can cut expenses, and create some additional income for themselves that way. All right. So if the deal immediately looks to be dilutive, we can calculate, we can back into, well, what would be the amount of pre-tax synergies required in order to make this a break-even deal? All right. That is, keep earnings per share the same after the deal as it was before. Okay, and then we can also, like everything else we do in banking, we can put together a lot of different data tables, look at different structures, different premiums that we might pay that would make the deal less dilutive, different structures of that consideration, maybe borrow some of the cash, maybe fund it off our balance sheet, maybe issue stock. All right, so you'll see at the end of this, we can create a lot of data tables to figure out what the deal could look like under different scenarios. All right, a couple items to keep in mind. Fully diluted share counts of the target, just like when we did our precedent transactions approach, must take into account the automatic vesting of options. Remember, options vest on change of control. This would be a change of control transaction. So this would be a change of control transaction. Those options would vest. We would determine, based on the offer price relative to the exercise price, how many of those are in the money. We would do our treasury stock method and calculate fully diluted shares based on that automatic vesting. All right, so that's one thing to keep in mind. All right, the second thing to keep in mind is the consideration used to finance the purchase of the equity. Are we issuing stock? Are we paying cash? Kind of talked about that before, and how that impacts either interest expense or interest income if the company's either borrowing to fund the cash portion or using balance sheet cash. And then pro forma ownership, most of the time, obviously, the buyer is going to want to control more than 50% of the target after the deal. Not always the case. Sometimes you'll see reverse mergers, but for the most part, that's typically true. Pre-tax synergies, we touched on this before. Again, if the deal looks to be dilutive, we can solve for how much in the way of synergies are required to break even. The theory being that if the buyer is able to achieve that amount of synergies, let's say 100 million of synergies, if they can achieve that, then the deal will be break even, will not be dilutive, and it would ideally have a minimal impact on the buyer's share price. What happens when a deal typically gets announced? What happens to the buyer's share price? What happens to the seller's share price when a transaction gets announced? Yeah, seller usually goes up, all right? Buyers typically need to offer a premium to the seller's share price. So if a seller's trading at $30 a share, a buyer's going to have to probably offer 35 or 40, something in that range maybe, to get the deal done. The seller's shares will typically trade up, usually to just a little below where that offer price is. Sometimes more. If an unsolicited offer gets made, say the buyer goes in, makes an offer at 35, but the market still thinks the deal's undervalued, the seller is resisting the transaction. All right, think of Kraft and Cadbury right now. Sometimes those shares will trade above the offer price because the market thinks the buyer's going to have to come back and offer more. All right, so typically the seller's shares trade up, and typically the buyer's shares trade down a little bit. And one reason is, number one, that premium. They've got to finance that premium. And secondly is the question of whether or not the buyer's really going to be able to get synergies out of the deal, whether the deal is actually going to end up being accretive or a good deal for the buyer's shareholders. And I think historically, if you look back, all M&A activity, and there have been studies done, but most M&A activity has actually been found to have destroyed shareholder value. All right, most deals in the long run end up being dilutive, and usually that's because of that control premium needs to get offered up front. and the buyers just usually aren't able to integrate the transaction and really make it pay for itself over time. All right. So the market is skeptical, as well it should be, that these deals can actually work. All right, calculation for pre-tax synergy is pretty straightforward. Again, we're just solving for what the amount of synergies would need to be. You'll see this in the model when we get into it. All right, we'll solve for the amount of synergies to make the deal break even. And once we know what that pre-tax synergy amount is, say 100 million, 200 million, or whatever, a lot of times what we'll do is we'll look at that as a percentage of revenues, maybe a percentage of EBITDA, maybe as a percentage of operating expenses, all right, to see exactly how feasible it would be. If the buyer's got to cut 50% of its operating expenses to make a deal work, it may not be the best deal. All right. But if their synergies turn out to be a very, very small percentage of revenues or EBITDA or operating expenses, the market might say, okay, that makes sense, that should be doable, and this should be a good transaction. All right, so that's typically how that's used. Exchange ratios, collars. I'm certainly not going to read all the text on this. Basically, I would say read through this on your own time at some point. This basically says that when a deal is structured, typically there'll be what's called an exchange ratio. All right, if there's going to be stock offered in the transaction. We're going to teach you how to calculate the exchange ratio in a moment. And the exchange ratio basically says for every share of the seller's stock, how many shares of the buyer's stock are being offered. So sometimes it's, maybe it's 1 share. Typically it's a fraction of a share. A half a share, 0.67 shares, 1.5 shares, etc. All right, we're going to teach you how to calculate that in connection with our hypothetical deal. But the buyers and sellers can also put in things called collars, really meant to lock in ranges of value and ensure that the buyer doesn't end up having to pay way more than it expected to pay. The seller doesn't end up having to take way less than it expected to take when the deal finally closes. All right, because again, if it's a stock deal, stock prices can fluctuate between the time a deal gets announced and the time it closes. And so if the buyer's share price goes way up or way down and it's a stock deal, that can affect the consideration to both parties. Goodwill, also not going to spend a whole lot of time here because we've talked about it, I think, on several occasions now. Goodwill is calculated as the difference between market value and book value, and it can no longer be amortized. All right. Other things that can no longer be amortized, a lot of different deal fees cannot be amortized. The only thing fee-wise nowadays that can be amortized are financing fees. So if the buyer raises some debt to finance the deal, then the fee associated with that debt can be booked as an asset, amortized over time. All right, and goodwill is not amortized but tested annually for impairment, like we've talked about. Again, sensitivity tables will show you, we've already run through how to create data tables. These are some of the types that oftentimes are created. Figuring out what the range of share prices paid relative to the premium, ranges of considerations, ranges of options for how we finance that cash purchase price, the cash portion of the purchase price rather, PE ratios, accretion, dilution, etc. All right, so we'll see some of those when we get into the model as well. All right, so let's actually, before we get into any of this, let's open up the model. I want to show you what the model looks like. So if you go into your folder 6-7 merger modeling folder, what you're going to do is open the accretion dilution Kraft Kellogg shell file. And this is actually what we're going to be working in a few minutes. All right, so if you want to open that up, we'll just kind of walk through and show you what's contained in here. First thing I'll point out is, unlike a lot of our other models, this model only has 1 tab. Right? You're probably rejoicing about that. Right? So everything is contained on 1 tab. Like I said before, it's a pretty straightforward, simple model to put together. And we'll walk through the model. First thing we're going to need to input are the buyer and seller names. All right, so who's the acquirer, who's the target? When we enter those names in the model, you'll see that anywhere it says acquirer-input, targets-input, the dash input portion of that will change to reflect whatever names we enter there. All right, so we'll see that in a little while. What is the transaction date? Obviously very important. You'll see that transaction date here is the same as the date on which we spread all of our companies before, December 19th. All right, the reason I chose this is it will allow us to use a lot of the information we already have in our valuation model. Okay, if we hadn't already spread these companies, that'd be the first step here. Spread Kraft, spread Kellogg, so we can get a sense for all of these items that are down below. What are their share counts on a fully diluted basis? All right, again, you'll see these hard-coded in the model because we're just taking it from another model. We've already done that work. What are their share prices as of that transaction date? What is the target share price offer? In other words, what is the buyer offering to pay for the equity of the seller? And once we enter that, we can calculate a premium. So what is the difference between the offer price and the current share price? What is the implied value of the target? Implied value of the equity based on that share price, that offer price? What is the implied enterprise value based on that? So we'll calculate those as well. And then we'll talk about what is the consideration of the deal. How much cash, how much stock? Sometimes a deal can be 100% cash, sometimes a deal can be 100% stock, sometimes it can be a combination of the two. And this model allows for any of those three circumstances. If we enter in the cash component as a percentage, we can calculate what is the share component. We can calculate that on a per share basis, and also calculate that in total, as we'll see when we get into our model. Next item, what is the source of the cash component? So are we pulling cash off the buyer's balance sheet, or are we borrowing, like we said before? And then what is the interest rate associated with both? Remember, if we use balance sheet cash, there's a cost to that as well. It's lost interest income, so we need to be able to calculate that. So we need to know the interest rate earned on cash. We also need, obviously, the interest rate that the company would pay on any new debt. Okay, if it's a stock deal, we'll calculate how many shares are issued, how many shares of the buyer get issued to the seller to finance the deal. We'll also calculate that exchange ratio that I mentioned before. All right. And then once we have all of the information we've just gone through, we can calculate pro forma ownership. That is, how much of the combined company is owned by the buyer shareholders, how much is owned by the seller shareholders. This will be a stock deal, so it'll be a combination of both. Buyer shareholders will have some ownership, the sellers will have some ownership. At the end of the day, the buyer shareholders will own a majority of the combined company, which is pretty typical. All right, we've got a section to input. What do we expect pre-tax annual synergies to be? If we're working with the buyer, or maybe if we're working with the seller and we have an idea of what those are, this is where we would input that in dollars. So 100 million, 200 million, what have you. Typically a lot more work goes into that than just pulling a number out of the air. All right, but we would, at any rate, we'd want to enter that in. Also be able to calculate that on an after-tax basis, and I'll show you where that links into the model in a little while. And then this section here where everything is highlighted in yellow, this is where pre-tax synergies required to break even are. We talked about that before. Once the model is done, those values will calculate for us. Okay, down below, we've got what we're calling a multiples analysis. All right, so we're going to calculate some valuation multiples associated with the buyer, associated with the seller, and associated with the pro forma combined company. And so what does the buyer look like? What's its price earnings multiple? What's its total enterprise value to revenue multiple? What's its total enterprise value to EBITDA multiple? Same thing for the seller, and then same thing for the combined company. So we basically need to capture all of those items that we need to calculate enterprise value. And then we'll have revenues, EBITDA, EBIT, net income pulling from somewhere else in the model. It's a pretty straightforward analysis. It really is. Just like anything else, most banks will have a template for this. If you really just follow the template, it's kind of hard to make a mistake. We'll get through this in probably no more than an hour. Right. If we scroll up and to the right, again, on the same tab, there's only one tab in this model. We've got earnings per share, both on an LTM basis and a forward basis for both companies, buyer and seller. These numbers, you'll see that they're hard-coded. We've pulled those from the valuation model, basically the numbers that those analyst reports gave us. So those Credit Suisse reports told us what those EPS forecasts were going to be. The LTM EPS we calculated based on what our spread indicated. So those are pretty straightforward. We can use those combined with a share price for each company to calculate PE ratios. So what is the PE ratio of the buyer? What is the PE ratio of the seller? All right, based on their current share price and also based on the offer price for the shares. So we'll do that. And then as we scroll down, we're actually putting together a shortcut income statement, if you will, a summary income statement. What were the buyer's revenues on an LTM basis, on a forward basis? Same for the seller. What do we expect the combined company to look like, top line? Do the same thing for EBITDA. Right, again, EBITDA being a proxy for cash flow. Do the same thing for net income. But when we talk about net income here, we're talking about before we take into account any effects of the transaction. Right? Anything that can be dilutive or even possibly accretive. All right, so before we take into account synergies, before we take into account amortization of any intangibles that arise from the deal, before we take into account any lost interest income or additional interest expense. So what we're doing is taking that unadjusted net income, we adjust it for those items that can be either accretive or dilutive, and that gets us to pro forma net income. What does the income of the company look like on a combined basis after we account for all those accretive and dilutive items? And if we divide that by pro forma shares outstanding of the combined company, it'll give us pro forma EPS. Once we have pro forma EPS, we compare that to the EPS of the buyer prior to the transaction, and it tells us, is the deal accretive or dilutive? Right. Might sound like a lot, might seem like a lot of steps, but again, this is a pretty straightforward analysis. I think once you get into it, you'll see that as well. All right, let's go back to the slides quickly. What I want to do is review a couple more of these slides. We'll talk a little bit more about the Kraft-Kellogg transaction in a moment. All right, and actually here on slide 13, where we've got some assumptions around a potential transaction, these are actually assumptions you're going to use in your homework. All right, so this is going to be part of your homework exercise. The buyer, it's a hypothetical buyer, hypothetical seller. We didn't even get too creative in naming them Company A or Company B. It's just acquirer and target. Okay, buyer's going to buy seller for $18 a share, which is 100% or a 20% premium to their current share price. They'll finance it 50-50 cash and stock. That exchange ratio will end up being 0.31x, which is another way of saying for every share of the target that's getting purchased, the buyer is going to issue 0.31 shares of its own stock as currency, as consideration for that, plus $9 in cash. And that cash portion will be financed with debt. They'll draw on their revolver to finance it. And the buyer is also going to assume all the target's outstanding debt and liabilities. These are just a few of the assumptions you'll use in your homework. The rest of the assumptions in your homework are in the homework folder in the accretion dilution instructions file. All right. But that's just some of the assumptions that you'll be using. All right, and again, the goal is to build a shortcut accretion dilution model. Basically, as I just talked through, the instructions will teach you how to input the fully diluted shares, current share prices, calculate the offer price, calculate the premium. It'll give you projected revenues, EBITDA, income, earnings per share, all those items. It'll give you a tax rate. So all those other assumptions will be included in that file. And then here is a step-by-step. All right, I'm not going to read through these, just like all of our other models. Until we actually do one, these step-by-step approaches aren't going to make a lot of sense right now. But if you ever need to go back for a reference, it's on page 6. It starts on slide 16 and goes for a few slides. And also tells you how to calculate those sensitivity tables. All right, but let's talk about the example we're going to do in class. Again, this is a hypothetical deal, Kraft buying Kellogg. In this case, we're assuming Kraft is buying Kellogg, buying 100% of the company for $48 a share, which ends up representing about a 13% premium to Kellogg's current share price. This transaction, the $48 per share amount will be financed $9.60 in cash. So every share will get $9.60 in cash. Each share will also get 1.44 shares of Kraft stock as consideration for the deal. Okay, that cash purchase price, cash portion of the purchase price will be financed through borrowing. Kraft will borrow under its revolver. They pay 6% on their debt. They earn 4% on their cash. And Kraft will also assume all of Kellogg's outstanding debt and all of their liabilities. Okay, so when we calculate the combined balance sheet, we not only want to take into account the new borrowing here, we also want to take into account Kellogg's debt that gets assumed in connection with the deal. Make sense? Okay, let's go back into our template and we can start actually building the model. Just like every other model, it's always a good idea to run in manual mode. All right, so you probably just want to make sure you're set up to run manual calc. All right, so the first step here, enter the buyer and seller names. So the buyer, again, is Kraft. Seller is Kellogg. You could enter ticker symbols too. Really just kind of depends what your preference is. All right, I just entered the full names. And when you hit F9 to recalc, you'll see that every place it said acquire-input or target-input, now instead of input, it has the buyer and seller names. And if you want, you can look at that formula where it's basically adding some pre-populated text to the text that appears in these cells. Just kind of a nice piece of Excel functionality. Elegant way to link that up. Again, transaction date, December 19th, 08. We've got their share counts, we've got their share prices. Again, those came from our spreads. And if we did not already have these companies spread, you'd have to do that. You'd probably spend a few more hours doing that. So that can be a little time consuming, as we know. Next thing we need to do, enter the share price, the target offer price for Kellogg, which we said was what? $48. We'll enter 48. And now that we have that, we can calculate our premium. The way we calculate that is we say equals, in this case, B19, or that target share price offer, divided by their share price immediately before the deal, or B16. So B19 divided by B16 minus 1. It's the same formula we use for a one-period growth rate. So it should look familiar. And just like we said when we talked about the assumptions, it ends up being about a 13% premium. Pretty consistent, if you recall, back to our precedent transactions approach. When we looked at all those different deals, 13% was kind of right in the middle there. All right, so pretty representative of this industry based on historical deals. All right, now based on this, we can calculate the target, the value of the equity for Kellogg based on the offer. And how would we do this? Yeah, offer price times shares outstanding. Okay, so we'll take that $48 a share, we'll multiply it by 381.7 million shares outstanding. okay, or equals B19 times B12, implies a value of the equity of $18.3 billion. Another way of saying that is the market value of equity, the MVE of the deal, is $18.3 billion. So that's the equity value. We also want the enterprise value of the deal, right? Because if we're going to calculate enterprise value multiples, we need to have total enterprise value. Okay, and actually, instead of calculating it right here, what we're going to do is we're going to link down to our multiple analysis section. We can link to cell E66. Actually, before you do that, hit F9 to recalc. Now we can link down to cell E66, where it's calculated for us, $23.2 billion. So what this multiples analysis section does is it takes that $18.3 billion market value of equity we calculated a moment ago. We're adding debt, we're adding preferred, we're adding minority interest, and we're taking out cash, just like we know how to do, just like we've always done, calculating enterprise value. We're just doing it in a separate cell here. All right, so the equity value of the deal, $18.3 billion. Enterprise value or transaction value, $23.2 billion. Next thing we want to do is we want to start analyzing the consideration for the deal. In my lecture slides, we talked about the deal having a cash component equal to $9.60 a share. As a percentage of the total, it ends up being 20%. Right, so where it says input for the cash component, we're going to input 20%. And when you hit F9 to recalc, all of these other cells in this area should recalculate for you. First of all, the acquirer's shares issued as a percent of the total deal. It's just going to be 1 minus the cash component. And if we pay 20% in cash, obviously the remainder has to be paid in stock. So that's 80%. If it was a 50-50 deal, you input 50 for cash, hit F9 to recalc, and everything calculates for you there as well. All right, so the way we've set it up is so that we can sensitize on that. We can change that cash component of the deal anytime we want to or need to. All right, if we multiply both of those by the offer price, it'll give us the implied price per share for both the cash and the stock consideration. So just like we said in the assumptions, Kellogg is going to get, their shareholders are going to get $9.60 in cash per share, plus some shares of Kraft, all right, and those shares end up being worth $38.40 a share, because the two have to add up to 48. That's the offer price. We're just splitting it among cash and shares. And then we also look at it on an aggregate basis. So that $18.3 billion market value of equity breaks down to being $3.7 billion of cash, $14.7 billion of stock. Makes sense. All right, so let's look at the cash component here. Let's set this up. Remember how we said they were going to finance this? Kraft was going to finance the cash portion of the deal by borrowing. That is, they're going to use no balance sheet cash. All right, so what I'm going to enter here for cash on balance sheet, I'm going to enter 0. Remember the interest rate I earn on my cash was 4%, so we'll enter 4 there. Now what would be the right way, now that we get to the debt line, what would be the right way to calculate how much debt Kraft is going to issue here? Or how much they're going to borrow to fund the cash portion? No, not 20. Wait, did you say what?
Cash component 20%.
Well, no, this is how they're going to fund the cash portion.
Yeah.
All right, so they're going to borrow $3.7 billion. All right. It's 20% of the whole deal. Right, of the whole deal. But of that 20% that's cash, they're borrowing for 100% of that.
Right.
Right? So what we're going to say here, you could say just equals D26, or that cash component. But what we want to do is set up our model so that we can sensitize it later. All right, so when we do some data tables later, everything will automatically calculate. So if we want to sensitize maybe one scenario where they're actually going to use some balance sheet cash, we would want to calculate that to come out of the amount they're going to borrow. So what I want to say is D26 minus whatever they choose to fund using balance sheet cash. All right, so let's say let's say the deal terms change. Kraft decides all of a sudden, hey, we want to fund, $1 billion of that $3.7 billion with balance sheet cash, borrow the rest. We enter $1 billion here. This automatically updates. Right? That's why I'm doing it the way I'm doing it. All right, so I'll change that back to 0. And then the interest rate on our debt, 6%. And I'm going to skip the exchange ratio for now because I don't have enough information to calculate it yet. First, I need to know how many shares are being issued in total. All right, once we know that, then we can calculate the exchange ratio. How would I figure out how many shares of Kraft stock would need to be issued here? Right. If I look at the value of the stock that needs to be issued, I know how much stock I need to issue. I need to issue $14.7 billion worth of stock if I'm Kraft. I also know that Kraft is trading at $26.67 a share right now. So if I divide $26.67 into $14.7 billion, it will tell me how many shares I need to issue. In other words, equals D27 divided by B as in boy 15. And when I do the math, it tells me that Kraft is going to have to issue almost 550 million shares. 549.6 to be precise. So now how do I calculate my exchange ratio? So basically, what we're saying in exchange ratio again is how many shares of the buyer get issued for every outstanding share of the seller. And so the way we can do this, if we know that 549.6 million shares get issued, if we divide that by how many shares are being purchased, that is, how many shares of Kellogg stock are being purchased, it will tell us what the exchange ratio is. So equals B38 divided by B12, or that 381.7 million shares, which gets us back to that exchange ratio of 1.44 that we talked about in the assumptions. Does that make sense? Okay, when we hit F9 to recalc, you should also see now that on a pro forma basis, that is after the deal is done, there will be 2.0248 billion shares of Kraft stock outstanding. And the way we calculated that is we took basically how many shares of Kraft is outstanding now, before the deal, 1.475 billion. We added to that the 549.6 that they issue, and that's our pro forma share count. Okay, so at this point, we now have the denominator in our earnings per share calculation. We know how many shares are going to be outstanding after the deal. The rest of the modeling exercise is going to be geared toward calculating what is pro forma net income of the combined company. All right, so we've already solved for half of the equation. Everybody follow that? We can also look at the ownership, like I said, on a pro forma basis after the deal is done. Because this is a stock deal, the target shareholders are going to own some of this stock of the combined company afterward, right? If it were a cash deal, then Kellogg or Kraft just pays all cash, those seller shareholders go away, and the buyer, Kraft in this case, would own 100%. All right? But because it involves stock, the seller shareholders own some of the company, and in this case, they end up owning about 27% of the company afterward. They own 549.6 million shares out of the total 2 billion, 24 million, etc., which ends up being 27%. Kraft shareholders own about 73. Majority control. Okay, the next thing we're going to do, because we're going to need this in our model later to calculate pro forma net income, we're going to enter a number for pre-tax annual synergies. That is, what is the dollar amount of synergies Kraft expects from the deal, or we expect Kraft to derive from the deal. In this case, we're just going to assume 0. It's the base case of our model. We're going to run the deal with no synergies whatsoever, and let's see how it comes out. And then, like I said earlier, if it looks to be dilutive at first, and this deal will be a little bit dilutive, then we'll be able to calculate, well, what if this number was higher? What if they were able to get synergies? How much would that need to be in order to make the deal break even? All right, so we're going to run this first of all at 0. Let's assume a pro forma tax rate or an effective tax rate. I think it's 40%. Let's assume 40%. Then if you hit F9 to recalc, okay, right now you'll see some numbers in here. All right, don't pay attention to these just yet. They don't mean much until the model's done. All right, these numbers will change. But let's calculate what post-tax synergies would be. What would the formula for that be? Yeah, it's just pre-tax synergies times parentheses 1 minus T, or 1 minus B47. Again, net income is after tax. So everything we do, all of those items that can be accretive or dilutive, we need to tax affect them. All right, so if we have, say, 100 million in synergies, on a post-tax basis, that would end up being 60 million of benefit. Right? 1 minus the tax rate times 100 is 60. Okay, so we're going to run this at 0. So it's 0 pre-tax, 0 post-tax. All right, let's go down to the multiples section. And we saw it before. Kraft, we'd already populated this cell based on the spread that we had done for them earlier, based on the current share price. Gives us a market value of equity for Kraft, a little over 39 billion. Total enterprise value, just north of 59 billion. For Kellogg, we calculated two ways. We calculated based on their current share price. We also calculated based on the offer, right? Because we need to know what the value of the transaction is. This is what, again, we linked to earlier. Based on their current share price, enterprise value of 21 billion. Based on the offer, 23.2 billion. That number that we saw earlier. All right, so for the seller, we calculated both ways. Okay, and we can see also we've got some multiples here, both for the buyer and the seller. We've got our enterprise value to revenue, enterprise value to EBITDA multiples. We don't have anything for price earnings yet because we haven't gotten to earnings in our model. And when our model's done, we'll have PE ratios as well. All right, the interesting thing to point out here is that Kellogg actually trades at higher multiples than does Kraft. Their TEV multiples are higher. On a revenue basis, when you look at total enterprise value to EBITDA, the value of the offer ends up being higher in terms of their multiples than Kraft as well. All right, and that'll also be true of net income. So if you remember back to the slides, I talked about a buyer paying a higher multiple of earnings for a seller. We're going to see that in a moment. Right? And that's one factor here that's going to cause the deal to be a little bit dilutive. Okay, let's go over to this pro forma combined companies column though. Let's calculate the value of equity, the enterprise value for the combined company. Because it's interesting to see them on a standalone basis, but at the end of the day, what's important is what they look like on a combined basis after the deal's done. So after the transaction is complete, how many shares outstanding do we have? Yeah, remember, we've already calculated that. A lot of people make the mistake of saying, well, there were 1.5 billion of Kraft, there's 381.7 of Kellogg, let's add them together. All right? And in some of these rows, that's going to be appropriate. Not here, though. All right, so you need to be a little careful when you're putting together this pro forma column. It's not always as simple as just adding the buyers to the sellers. All right. Okay, so we know that we're going to have a little over 2 billion shares outstanding on a pro forma combined basis. What share price should we use to calculate the market value of equity? The acquirer, right. All of these shares are Kraft shares. All right, the existing Kraft shares are valued at $26.67. That's what they're currently trading at in the market. The new shares were issued based on an implied value of $26.67, $26.67. So our share price here is also $26.67, Kraft's share price. Does that make sense? And to calculate market value of equity, we just multiply the two. 2 billion shares, 26.67 a share, gives us a combined market value of equity, 54 billion after the deal's done. All right, let's move down here. Again, the goal here is to calculate total enterprise value. Remember back to what we said in the assumptions. When Kraft buys Kellogg, they're going to also acquire Kellogg's debt. So over here, for debt, we're going to have Kraft's debt. We're going to have Kellogg's debt. But is this everything? Yeah. Kraft also borrows to fund the deal. All right, so again, it's not just a matter of adding Kraft's debt to Kellogg's debt. Remember, to fund that cash portion of the purchase price, Kraft is going to borrow. So to this number, we need to add that 3.7 billion in cell B33. We need to account for that as well. So pro forma debt for the combined company is 29.8 billion. Well, for preferred and minority interest, in these cases we actually can just add Kraft's preferred to Kellogg's preferred, Kraft's minority interest to Kellogg's minority interest. It's zero. But the transaction does not involve any of those items. All right, so we don't need to make any changes to those. We add them together, those stay zero. And for cash, if we add those together, we also need to add something else. We also need to add from up above any balance sheet cash that could get used in connection with funding the cash portion of the purchase price. In this case, it's zero, but again, when I set up my model, I want to be able to set it up to run sensitivities. So if I change my assumption around how Kraft finances the cash portion of the purchase price, let's say they're going to use $1 billion in cash, I need that to flow through to my pro forma model. So they use $1 billion in cash and it would automatically reduce that cash balance. Does that make sense? And then our enterprise value, if we just take the sum of cells G60 to G65, will give us an enterprise value 82.4 billion. When we hit F9 to recalc, we actually do see now some enterprise value multiples of the combined company. All right. So on a combined basis, assuming no revenue synergies, no cost synergies, anything like that, we see that you're going to trade at 1.5 times last year's revenues, 1.4 times next year and the year after. Also got EBITDA multiples as well. But no price earnings yet. We still haven't gotten to earnings. All right, we're still working on that. Any questions so far? It's pretty straightforward analysis. This is I think the easiest modeling exercise we do in this class. All right, so on to determining earnings. So I've scrolled up to the top of my to the top right side of my model. And like we said earlier, we've got earnings per share for both Kraft and Kellogg on a latest 12 months basis, also forward earnings that we took from analyst reports. Right, so the first thing I want to do here is I want to calculate price earnings ratios for each company. This is interesting. This is going to tell me a little bit about the deal. Like I said before, if Kraft is paying a higher, if the deal involves a higher PE multiple for the target than it does for the buyer, than the market is currently valuing the buyer, and the buyer's issuing shares, that can be dilutive. So this can give us a clue as to whether the deal will be accretive or dilutive. Interesting to look at. So for the buyer's PE ratio, I'm just going to take Kraft's current share price. I'm going to lock on that because I'm going to want to copy this across, divided by their LTM earnings, or H11. And then I can fill that to the right, hit F9 to recalc. Make sure you lock on the share price. So B15 divided by H11 in that LTM column. Okay, we're also going to do this based on Kellogg's current share price. So we're going to divide B16, I want to lock on that, divided by H12. Can fill that to the right. And what we see here is that on an LTM basis, at least, Kellogg is trading at a slight discount to Kraft in terms of their price earnings multiples. Kellogg's trading at 13.7 times earnings, Kraft is trading at 13.8. But when we look at this using the offer price to calculate Kellogg's price earnings multiple, or B19 divided by H12, we can see that when we add that premium in, now the value of the deal, or the deal values Kellogg at 15.5 times latest 12 months earnings, 15.9 times next year, 15.2 times 2009 earnings. So this is what I was referring to earlier. The transaction values Kellogg more highly in terms of its PE ratio than Kraft is currently being valued by the marketplace. And because Kraft is issuing shares of its own stock, it has to issue proportionately more shares of its stock for every dollar of earnings of Kellogg. Another way of thinking of this is the numerator is growing a little more quickly than the denominator, if you look at that deal. That alone will make the deal a little bit dilutive. All right, so let's go down, let's look at our pro forma income statement. Again, like I talked about before, these blue numbers are just came right from the spreads we did earlier. Kraft revenues plus Kellogg revenues gives us a combined revenue number for the pro forma company. We're not assuming any additional sales as a result of the deal, no revenue synergies. Right. EBITDA, same thing. Pro forma company just combines Kraft and Kellogg, no cost synergies assumed. And now what we need to do here is we actually need to calculate net income because these earnings per share numbers are on a per share basis. They're not on an aggregate basis. We need to convert these into an aggregate dollar amount for each company. When we do that, we add them together. It will give us an unadjusted net income number that will then adjust for the accretive or dilutive impact of the deal. Does everyone follow that? So for Kraft, what I'm going to say is I'm going to take their earnings per share on the latest 12 months basis, going to multiply that by the number of shares outstanding. H11 times B11, I want to lock on B11 because I'm going to copy that across, and we've just converted their earnings from a per share number into an aggregate dollar number. All right, so that's Kraft. For Kellogg, we're going to do the same thing. Take their LTM earnings per share. Oops. H12 times their current shares outstanding, because again, these earnings per share figures were calculated based on that fully diluted shares outstanding. So we're going to use that to convert them back. And so what we should see is that Kellogg had latest 12 months earnings per share of about 1.18 billion. Next year, 1.15. 2009, 1.2 billion. Okay, so now at this point, we've got net income for the combined company before we account for the transaction and how it's going to affect the combined company's earnings going forward. Before we factored in synergies, before we factored in any amortization of intangibles, before we factored in any additional interest expense or lost interest income. Does that make sense to everyone? I'm locking on B12 in that last formula. So for the target's net income for the latest 12 months, I took H12 times $B, $12. And then I just filled those to the right. All right, well, let's work on those items, those accretive and dilutive items. And again, once we've accounted for these, when we take our unadjusted net income, we add or subtract these accretion or dilution items, we'll get pro forma net income, or we got our numerator. in our accretion dilution formula. And then each year we'll just run this fraction, tells us what our pro forma earnings per share will be. We'll look at that compared to Kraft's earnings per share before the deal, and it'll give us a sense of what impact did the deal have on Kraft's earnings per share, or will it have. All right, so post-tax synergies. In this case, we've already calculated those over here. B48. I want to lock on that because I'm going to copy that across. Okay, so this way, even though these synergies are assumed to be 0, when I set up my data tables, I can sensitize on that and say, well, let's assume 20 million of synergies. Let's assume 50 million. Let's assume 100 million of synergies. How does that affect my model? All right, and it will flow through here, again, on an after-tax basis, because net income is after tax. All right, before we do amortization of intangibles, let's scroll down a little bit. And I want to set up another section of this template here. And then in a moment, I'm going to teach you how to run an if-then statement and incorporate that. Not because it has a real effect on the value in the model, but really just because I don't think we've set one up together yet. All right. First thing I want to do here, and the way this is set up is that initially when we built these models a number of years ago, goodwill could be amortized. Right. And a lot of the other amortizable intangibles or deal-related fees could be amortized as well. So this was a lot more important earlier. Now, as I said earlier, today, there are very few fees that can still be amortized. All right. But let's set this up. Let's calculate goodwill first. So in cell I-49, I want to take market value of equity from the deal, 18.3 billion, or B22, minus book value, or I-48. And it tells us that the deal is going to create about 15.7 billion of goodwill. A lot of goodwill. A lot of goodwill. Additional amortizable intangibles. Now this is where if we had financing fees associated with the deal, we'd enter them here. I'm just going to enter 0. And then in this amortized intangibles cell, it asks us to input either yes or no. And this is what we're going to key off in a moment when we set up our if-then statement. All right, you can set it up so that if there's a no, or the text NO in a cell, then do one thing, otherwise do something else. All right, so we're going to do that in a moment. And if we are going to amortize intangibles, over how many years? All right, and actually let's have some fun with this. Let's put, and instead of 0, let's put 20 million for additional amortizable intangibles. And let's change that no to a yes. All right, we're going to change those back in a moment, but I want to show you how this impacts our model. All right, so change that additional amortizables to 20 million, change that to a yes, and keep 20 years for our amortization period. Let's go back up to our amortization of intangibles line, and we'll set up our if statement. Before we do that, I want to point out this says less. All right, we've seen this before. When something says less, it should be set up as a negative. So I want to say minus if, minus IF, left parenthesis. I want to scroll down to cell, what is it, I-51, that yes or no cell. If that cell, and I want to lock on this, F4 equals quotation. You need a quote here. Right. With the quote, it tells Excel you're looking for text. So if the text says YES, end quote, comma, so if that says yes, what we want to do, scroll back down, divide our amortizable intangibles, and lock on that. So I-50 divided by I-52, lock on this. You need to lock on all of these cells, comma 0. All right. I'll leave this up so everybody can get the right references in here, but I'll also interpret this for us just to make sure everybody understands what we just did. All right, so what I'm saying is if the text in cell I-51 equals yes, then what we want to do is take those amortizable intangibles that are in cell I-50 and divide those by the amortization period. Otherwise, that is, if the text in I-51 equals anything other than YES, then just put a 0 here. And hit enter, and you should have a -1. Fill that across to the right, F9 to recalc. And because we locked on it, we should have -1 in every cell. It's a nice way to incorporate an if statement into a model for calculation purposes. The if statements we've encountered so far, I think, really have been more for formatting. So if we calculate a formula and it gives us an error, then say NA or NMF or something like that. All right, here we're doing it for calculation purposes. All right, but that's basically how you set up an if statement. When we get into the full-blown merger model, you'll see that we've got it set up similarly. All right, to run one scenario or another based on a value that's been entered into a cell. It's kind of a cool, kind of an elegant way to run a couple different scenarios within a model. All right, so if that works, let's change that back, change our amortizable intangibles to 0, change our yes to a no, hit F9 to recalc, and you see that number go back to 0. All right, I really just wanted to illustrate and give you a chance to do an if statement. And those if statements, I think I mentioned it last week, they can be really, really powerful, also very complex. You can have if statements within if statements, within if statements, within if statements, sometimes called nested if statements. The waterfall modeling that I think I've sent to a couple of you in class has a lot of that. All right, so if anybody wants that private equity waterfall model, send me an email and I'll shoot that out to you. All right, and the last thing we need to adjust for here is interest expense from the transaction. All right, remember, when Kraft borrows, they're going to incur some interest expense. Interest expense reduces net income. If they used cash from their balance sheet, they would forego some interest income, which would also reduce net income. So we need to account for that here in this model. What we want to say is minus, I don't think we need a parenthesis, minus B31 lock, oops, let me just redo this. Actually, use a left parenthesis, minus parentheses B31 lock times B32 lock minus B33 lock times B34 lock times 1 minus the tax rate lock. Actually, we don't, my apologies, we don't need the minus at the beginning. So the formula is equals parentheses B31 times B32 minus B33 times B34, that quantity times the quantity 1 minus B47. And all of those cells should be locked on. And when you fill that across to the right, you'll know that you've done it correctly if it's the same number in every year. Okay, so you should get minus 131.9. I actually think the solution reflects a 35% tax rate. Yeah, it does. All right, so actually change your tax rate to 35%, and you should get minus 142.9 every year. So I know the solution for everybody who's watching the video, they're going to get 142.9, and that should be the solution. So the tax rate should be 35%. You should get 142.9 every year for interest, additional net interest expense. And what we should see now for our pro forma net income is $3.9 billion in year 1, $3.8 billion in year 2, $4.0 billion in year 3, which represents a reduction to that unadjusted net income, accounting for that new interest expense. And if we divide that every year by our pro forma shares outstanding, it gives us pro forma earnings per share, $1.92, $1.89, $1.98. And then in this accretion dilution line, you can look at the formula. Basically what it's doing is comparing pro forma earnings per share to earnings per share of Kraft before the deal minus 1 and telling us, is it accretive or is it dilutive? And the really important, probably the more important figure to look at here is the one that we've highlighted in yellow. What do earnings per share look like the first full year of the combined company's operations? Typically on an LTM basis, it's basically always negative because you're paying that premium right up front. And you're having to recoup that over time. And you'll see this a lot in press releases. They'll refer to earnings per share on a next year, on the first full year of combined operations, earnings per share will be, the deal will be mildly accretive or mildly dilutive, et cetera. And now because it is dilutive, we go back, the model goes back and it calculates pre-tax synergies required to break even. Basically saying, in other words, if the company were able to achieve, if Kraft were able to, say, cut $67.2 million of expenses before taxes, the deal would have no impact on earnings per share. And that $67.2 million represents a sliver, a small, very small percentage of revenue, 0.12% of revenue, and less than 1% of EBITDA. So the question really becomes, do we think it's feasible for them to cut 0.67% or 0.76% of EBITDA or 0.12% of revenue out of their expenses, or capture those as revenue synergies? And it's probably not a long shot, I would imagine. If this were 5, 10, 15, 20%, obviously that's a much bigger number. The market would view that with a lot more skepticism, and Kraft's share price would probably get pounded. All right. But that's basically our model. That's basically a shortcut model. So like I said before, if we have some basic information on both companies, if we have the information regarding the consideration for the deal, that is how it's going to be paid for, how the cash component's going to be financed, etc., we can calculate this, we can do this model pretty quickly. I think we did this model in all of about an hour at the most. Right, so this is a good first look at a deal if you're a banker, or if you're maybe if you're working in corporate development for a company like Kraft, looking at potential acquisitions. This is the type of thing you'd probably run quite a bit. Hey, what would it look like if we bought Kellogg? What would it look like if we bought ConAgra? What would that do to our EPS? Is it worth pursuing? So it's a nice first quick and dirty look at a transaction. Kind of does it pass the sniff test, so to speak. Maybe you're a buy-side banker. Maybe a company, maybe Kraft has engaged you to look for acquisition targets or to evaluate the feasibility of doing an acquisition of Kellogg. And you do the same thing. Right, your model, your homework is going to be basically the same thing. You're going to do one of these, different assumptions. They're outlined in the homework folder. There's an electronic assumptions file. Just follow that. It's pretty straightforward, just like this is. Like I said, this model is by no means rocket science. This is a very straightforward model. If you want to get more complicated, you can look at what we call a full-blown merger model, which you should have. It's the full merger model, Kraft Kellogg shell. You should have both the shell and the solution in that main folder. So you can open that up. And we don't have time to go through this in class, but now that you've done a short form model, you've got all the skills necessary to build a full merger model. You've got the financial modeling skills that we did in class 3 or 4. Okay, you've got the ability to create a pro forma balance sheet that we did in the leveraged buyout modeling, and you've got the M&A modeling that we've talked about today. All right, so you'll notice on this file, there are far more than just one tab. The first tab, this Merger Assumptions and Summary tab, looks a good bit like what we just did, except when you get down to this point on the right-hand side, you've got a section where we've got a base case or an upside case. All right, and this is all with respect to how we run synergies through our models. Okay, so we're going to have the opportunity to run a base case where there are no synergies, or potentially an upside case where we get a 1% improvement in revenue, a 1% improvement in gross margin, a 1% of improvement in SG&A. And based on whichever case you choose in cell I-28, that's what the model is going to run. So if you choose to run 1 base case, your synergies tab later on will reflect no synergies. If on the other hand you choose an upside case, your synergy models will have synergies later on. That gets modeled, that gets linked up using an if statement. All right, so I'll show you that later, how that rolls into the model. But this is where you can basically set up a logic gate, a 1 or 0, or 1 or 2 in this case, and decide how to run a model based on that. Okay, so that's our summary. Pro forma balance sheet, very similar to what we've calculated when we looked at leverage buyouts. In this case, though, we take the buyer, we take the seller, we make some adjustments, negative and positive. At the end of the day, the negative and the positive, we add it all up. The balance sheet still needs to balance. All right, so remember this deal created some goodwill. All right, if there were any intangibles like financing fees, those would get capitalized in there as well. All right, remember Kraft to finance the deal, they borrowed. So we'd want to roll those in. Kellogg's common stock, additional paid in capital, retained earnings, accumulated losses, treasure, all that stuff gets bought out. Some Kraft stock that comes on. All right, so you can work through that model and basically put together a pro forma balance sheet around that. You've got all the, like I said, all the tools necessary to do that. We've got an actual model here. In this case, it's only a 3-year model where we're going basically line by line. Income statement, balance sheet, cash flow, debt schedule. You can try your hand at doing a quick and dirty depreciation and amortization schedule at the very bottom of this. And it's very, very straightforward based on some assumptions we use around DNA. Okay, but this is very similar to what you did in the financial modeling course or financial modeling class. Got an assumptions page. Again, the assumptions page is where we put our drivers in. Our drivers then drive our model. So a lot of these items here will be blue. A lot of the things on the model tab should be black. Same rules apply that we went through earlier. All different types of assumptions from depreciation to balance sheet assumptions, CapEx, interest rates, payables. Right? If there's a line item on the balance sheet or the income statement, chances are there's an assumption associated with it. You'd enter it here. And then finally, a synergies model. Okay, and this is where we're picking up our choice back on the very first tab. All right, and actually, it's not an if statement. It's called a choose statement. All right, so we're choosing either a base case or an upside based on what we've entered in this choose cell. All right, very similar to an if statement. You could model this as an if statement too. It really doesn't matter. Okay, if this equals 1, then grab something over here. If this equals 2, grab this. Okay, but that's basically the model. I would say, even if you've got limited time, I would go through this rather than do another short form model. Short form model, as you saw, is pretty straightforward and easy. This is a little more time consuming. I think gives you a better idea of how all these modeling skills come together into one model. All right, this is actually a pretty fun exercise in my opinion.